So welcome back to the Millionaire Incorporated Forex Basics Trading course, Module 2 on charting. We're now going to go into Part 4 on Fibonacci and indicators. So what we're going to cover in this part is the basics of Fibonacci, how the Fibonacci retracement tool is used, and how to draw a retracement and extension, and also going to touch on some indicators. So another tool which traders use when trading is what is called a Fibonacci retracement tool. So have you ever looked at a chart and observed how after a pair has made a significant move in a certain direction, it retraces a certain amount before it continues in that original direction? So you're not alone with this thinking, and it typically retraces to a certain percentage area. So what this tool does is it works off the ratios that the mathematician Fibonacci used to identify certain occurrences in nature. So these ratios are actually also used in trading to help traders identify possible areas where price will retrace to before it continues in its original direction. So when the price of a Forex pair has made a significant move, we want to try and figure out how far it might retrace before it goes back in that original direction. So we want to use these ratios to help us identify possible areas of support and resistance that might provide us or give us a clue to where we can look for possible entries to continue with the trend. So there are a couple of common areas where it retraces to, and the two most common ones are the 50% and 61.8 retracement areas. And just because it does come to one of these areas does not mean that we can enter a trade straight away. We also need more confirmation. So as you can see in this little graph just here of the US CAD chart in 15-minute time frame, it's drawn a retracement tool from the top here all the way down to the bottom here, and you can see it's kind of retraced up from that initial impulse move down. So it's kind of come up to a 38.2% retracement. You could possibly also draw it from just this move here straight down. But let's jump into an actual chart now so we actually see what this actually looks like. So here we are back on the Australian Canadian dollar chart on the daily time frame, and so you can see here it's moving in a downward fashion over this period from April 15 to about August 2nd. So let's try and identify some areas where we might be able to draw a Fibonacci tool. So let's look at this area just here, how it made this impulse move down, a very strong move down, and you can see how it's retraced nicely up here. So you want to come over to here and grab a Fibonacci retracement tool. So that's just down here, and you want to draw from the top of that move there down to the bottom. Now I've actually got this set up as a certain template, but I'll just quickly change that. Bang, there you go. And you can see, so for that move there, from there to there, we start on this on the right hand side here, we have the percentages it retraces. So we have the 23.6, 38.2, 50, and 61.8. So you can see that after that pair has made that move down, it started retracing, and it's come all the way up to just past this 61.8 area before it's actually continued its way down. So I'm going to leave this here just for a second, and we can also use the Fibonacci ratios to project where price might move to. So this is what is called a Fibonacci extension. So it uses the same ratios but projects them past the area of where the price started its retracement from, and these are typically used for areas where we want to look at taking profit. And the most common ratios used for this are the 22.7 and 38.2% retracement areas. So kind of like a take profit 1 and a take profit 2 area. So let's go back over here to where the Fibonacci retracement or Fibonacci tools are. And you want to do a trend-based Fibonacci extension. So we go from here, where it started at the top, try line up exactly, drops all the way down to there, and then I just like to take the tool out just sideways from there. And you can see there, it's got the 23.6% extension and the 38.2% extension. So you can see that there's actually dropped almost right down to that 38.2% now. You can see over here it has actually done that and even dropped down to a 50% extension. So these are good indications, that good ways of actually identifying areas where price might retrace to, then also where price will extend down to further after it's retraced that area. So there are also tools that are called indicators, which I personally don't use a lot, but I do know a lot of traders that use them and also swear by them. So I'm going to go over them in a little bit of detail here. I'm going to go through the most common ones, so that if you want to actually go and learn about them, you're more than welcome to. There's plenty of tutorials on YouTube to find them. So I'm going to go over the most common ones here, and the first one I want to go over is an indicator called the RSI, or Relative Strength Index. So this tries to indicate if the currency pair is overbought or oversold. So it pretty much looks at giving potential indications if it's gotten to a level of buying where it might indicate that we might see some selling coming into the market of that currency pair. From here we move into simple and exponential moving averages, or SMAs or EMAs, and these give you the average price movement over a period of time of the pair. So these can be used individually or as a pair of lines, so like either two simple moving averages or two exponential moving averages, or one of each together, with different time periods. And they are charted as lines, and people either use the lines of support or resistance, or use the crosses of these lines to indicate that a pair might be time to look at either buying or selling of that pair. Next we have the MACD, or moving average convergence divergence, and this is a trend following momentum indicator that shows the relative or the relationship between two moving averages and a security's price. Then we move on to Bollinger Bands, and these are a type of statistical chart characterizing for the prices and volatility over time. So how people use these ones is you look for entries either short or sell when the bands have expanded and the price come into contact with these bands. So there are a few other indicators out there, and like I said, a lot of people use these indicators to try and predict the future of what the price might actually do. And some people actually live by them. I personally don't. So if you want to, by all means, go and look into them yourself. I've given you a name of the four most common ones people use. So that's the end of this part of the course. Stick around for the next part.